You're 30 years old. You just got a raise, 15% bump in salary. You're finally making decent money, so you celebrate. You upgrade the car, you move to a nicer flat, you book that holiday to Greece you've been putting off, and then 6 months later you're checking your bank account at 3 in the morning doing the same math you were doing before the raise. Wondering where it all went. Wondering why you still feel broke. Here's what nobody tells you about that raise. It didn't make you richer. It just gave you permission to spend more. And now you're trapped in a bigger cage with nicer bars. Welcome to the financial treadmill where your income goes up but your wealth stays exactly where it was. My name is Leo. I learned investing in the States, then moved to Europe and spent 9 years figuring out what actually works here. And I've seen the same pattern play out hundreds of times. People think the path to wealth is earning more, get the promotion, switch jobs, climb the ladder. But here's the thing, your salary isn't your wealth, your asset allocation is. And if you're a European investor, you're playing by different rules than the American advice you see plastered all over YouTube. Different tax systems, different retirement ages, different regulations, different investment vehicles, which means you need a different strategy. If you want to actually build wealth in Europe, make sure to hit that subscribe button and give this video a thumbs up because what I'm about to walk you through is the framework that actually works for European investors at every stage of life. Today, I'm breaking down the perfect portfolio allocation for every decade of your life. From your 20s when you should be maximally aggressive, all the way through your 60s when you're thinking about drawing down that pension pot. And I'm giving you 3 distinct risk profiles for each decade: risky, moderate, conservative. Because here's what most financial advisors won't tell you. There is no one-size-fits-all allocation. The right portfolio for you depends on your age, your risk tolerance, your income stability, and your financial goals. But what I can give you is a framework, a set of guidelines that work for most European investors. Think of this as your baseline, your starting point, and then you adjust based on your personal situation. But before we get into the allocations themselves, we need to talk about the 3 risk profiles, because understanding which profile fits you is more important than memorizing percentages. These profiles aren't just about how much risk you can handle, they're about who you are as an investor. Your timeline, your income, your relationship with money. And here's what's fascinating. Most people shift between these profiles as they age. You might be risky in your 20s and conservative in your 60s. That's not just normal, that's smart. So let's break down each one. The risky investor profile. This is the person who's weighted heavier in stocks throughout their entire portfolio, even into their 40s and 50s. And there's a good reason for this. Stocks have outperformed bonds for over 100 years globally. It's not even close. Take a look at this. If you invested 10,000 euros in developed market stocks back in 2012, that money would have grown to approximately 32,500 euros over the next 10 years. That's a 3.2 times return. Meanwhile, the best bond fund over that same period, around 15,600 euros. Everything else? Smaller. Stocks historically average 9 to 10% annual returns. Bonds? Usually much lower. Especially during Europe's negative interest rate period from 2014 to 2022 when bond yields were essentially non-existent. But here's the cost. That 9 to 10% average comes with down years. Big down years. Upwards of 30% or more when you look at the past 50 years of data. So who is the risky profile suited for? 3 types of people. First, someone young with a long time horizon until retirement. If you've got 30 or 40 years until you need this money, you can afford to ride out the volatility. Second, someone with a reliable income source that's growing considerably over time. You're not relying on investment income to pay your bills. Your salary covers your life. Your investments are building your future. And third, someone who actually likes managing money. You check the stock market on a daily or weekly basis. You believe your picks can outperform the market. You're engaged. The risky profile accepts short-term losses pursuing longer-term wins. But here's the key. As you approach retirement, you might shift from risky to conservative. Because at some point, capital preservation becomes more important than growth. And there's data to back this up. A study on generational investing habits found that younger European investors, specifically millennials, allocated approximately 90% of their portfolios to equities. Meanwhile, baby boomers maintained an equity position around 66%. That's proof. Things change with age. Reasonable investors shift their risk profiles throughout the years. Your 20s allocation shouldn't look like your 60s allocation, and that's exactly how it should be. Now let's talk about the moderate investor profile. This is where most European investors actually land. The moderate approach means you're holding somewhere between 50 and 60% stocks by the time you hit retirement. You want to grow your money, but with a balanced approach. You're okay tolerating some losses because you understand that's part of the game. And to get returns, especially later in life, you might need to accept short-term volatility. Here's some fascinating data. A portfolio with 60% stocks and 40% bonds had an average return of 8.6% from 1926 to 2018. Nearly 100 years of data. But here's what they don't show you in the glossy brochures. Some years, this supposedly balanced portfolio lost 20% in a single year. And the probability of seeing a 10% loss in any given year? Close to 40%. Let that sink in. A moderate portfolio isn't safe, it's just less volatile than a risky one. The median exposure to stocks across European households exceeds 60%. Most European investors are taking a moderate risk level approach. And here's why that's changed recently. Bond yields in Europe were terrible for over a decade. The European Central Bank ran negative interest rates. Bonds weren't returning anything, so even moderate investors shifted more heavily into equities because there was no alternative. But in the past year or two, bond yields started making a difference again as the ECB normalized rates. And now we're likely seeing a slow shift back toward moderate or even conservative risk profiles. Because bonds are finally offering returns worth considering again. The moderate investor wants growth, but not at any cost. You're willing to accept some volatility, but you want that cushion of bonds to smooth out the ride. You're not checking your portfolio every day. You're checking it maybe once a month, once a quarter. You've got a plan and you're sticking to it. And when the market drops 20%, you're uncomfortable, but you don't panic sell. That's moderate. Then there's the conservative investor profile. This is the most conventional school of thinking for retirement planning, and it usually involves something called the rule of 100. Take your age and subtract it from 100. That number is the percentage of your portfolio that should be in stocks. So if you're 40 years old, you subtract 40 from 100 and you get 60. 60% stocks, 40% bonds. As you age, the stock percentage drops and the bond percentage rises. By the time you're 70, you're at 30% stocks and 70% bonds. It's simple, it's clean, and it's designed for capital preservation. Why bonds? Because bonds are usually less volatile than stocks, especially in market turmoil. When stocks crash, bonds typically hold steady or even outperform. Look at the data from January 2020 to January 2021 during the pandemic. Global stock indices underperformed government bonds and corporate bonds for the majority of the year. During the March 2020 crash, bond swings were definitely less volatile. Bonds aren't exciting, but they're stable. And when you're close to retirement, stability matters more than growth. Who is the conservative allocation suited for? 3 groups. First, someone who wants a simple conservative approach and doesn't want to worry about the market daily. You set it and forget it. Second, people who believe in the rule of 100 or the rule of 110. You trust the conventional wisdom because it's been tested for decades. And third, risk-averse people focused on capital preservation. You've spent 30 years building this nest egg. You're not interested in gambling it away in your final decade of work. For European investors, there's an added layer here. Retirement age varies by country. France, you can retire at 62. Netherlands at 65. Germany, Ireland, UK, you're looking at 66 or 67. That difference matters. If you're planning to retire at 62, you need to shift to a conservative approach sooner than someone planning to work until 67. Your allocation strategy has to account for your country's retirement norms and your personal retirement goals. Now let's get into the decade-by-decade allocations. Starting with your 20s. This is where you want to be as aggressive as possible. You've got the most time left until retirement. Most portfolio managers agree, 100% equities at this age. Then you slowly reduce volatility over time. I'm going to give you 3 allocations for each decade, but let me be blunt. If you're in your 20s, you should be a risky investor. All the data about stock market returns beating bonds historically over the past 100 years, that's your playbook. You've got 40 years until retirement. Even if the stock market pulls back 30% in the next 10 years, you still have time to regain that lost ground. Plenty of time. Here are the allocations. Risky, 100% stocks, 0% bonds. The assumption here is simple. Stock market pullbacks happen, but over the next 10 to 20 years, you'll recover and then some. Moderate, 90% stocks, 10% bonds. You want a tiny cushion, but you're still heavily growth focused. Conservative, 80% stocks, 20% bonds. Honestly, I don't recommend this for your 20s. You're leaving too much growth on the table. But if you're exceptionally risk averse, it's an option. Now, what are you actually investing in as a European investor? You need UCITS compliant ETFs. That's a European regulation ensuring investor protections and transparency. You can't buy US domiciled ETFs like American investors can. You're limited to UCITS funds. And honestly, that's not a bad thing. UCITS funds are solid. For stock exposure, look at funds like the Vanguard FTSE All World UCITS ETF. Global Developed and Emerging Markets. The iShares Core MSCI World UCITS ETF. Global Developed Markets. The iShares Core MSCI Europe. UCITS ETF if you want European exposure. Or the SPDR S&P 500 UCITS ETF for US market exposure. For bonds, you've got options like the iShares Core Euro Government Bond UCITS ETF. Eurozone Government Bonds. The Vanguard EUR Eurozone Government Bond UCITS ETF. Same thing, different provider. Or the X-Trackers 2 Eurozone Government Bond UCITS ETF. These are your building blocks. And here's a critical note. When you're buying these ETFs, prioritize accumulating share classes over distributing share classes. Accumulating funds reinvest dividends automatically. You don't get taxed on those dividends until you sell. In most European countries, that's a huge tax advantage because unrealized gains aren't taxed. You only pay when you sell. Distributing funds, on the other hand, pay out dividends. And those dividends get taxed immediately. Now, there are exceptions. Austria, Switzerland, and the UK have tax systems where distributing shares might be equivalent or even better. But for most of Europe, accumulating is the way to go. Always check if an accumulating version is available. If it is, buy that. Your 30s, this is where life gets expensive. Mortgage. Family, or thinking about starting one. Generally more responsibilities. But here's the thing. You should still prioritize retirement contributions. Your 30s and 40s are the most important decades because these are your prime earning years. You're making more money than you did in your 20s, and you still have decades of compounding ahead of you. You can still afford a lot of risk. The data backs this up. Over any 20-year rolling period, the stock market tends to return positively. You've got 30 years until retirement. 20 years of positive returns still leaves you a decade to recover if things go sideways. Here are the allocations. Risky, 90 to 100% stocks, 0 to 10% bonds. If you're super risky, you might not change your allocation from your 20s. You're still all in on equities. Moderate, 85% stocks, 15% bonds. You're adding a bit more stability but still growth focused. Conservative, 70% stocks, 30% bonds. This is for someone who's already thinking about reducing risk even though retirement is still 3 decades away. And here's a caveat. As you age through any decade, you can shift your allocations. At 30, you might be at 90% stocks. By 35, you're at 85 or 80%. That's fine. The framework isn't rigid, it's adaptive. Consider your time horizon. Consider your financial independence number. If you're planning early retirement and you need this money within 20 years, it might be a good time to shift assets away from stocks for a more conservative approach. Now's also the time to take advantage of tax-advantaged retirement accounts available in your country. Germany has betriebliche Altersvorsorge, occupational pension schemes. France has the PER, Plan d'Épargne Retraite, personal pension plan. Italy has PIR, individual savings plans. The UK has ISAs and SIPs. These accounts offer tax benefits, and you should be maxing them out. Tax treatment varies significantly by country, so research what's available where you live. But the principle is universal. Use the tools your government gives you to reduce your tax burden and grow your wealth faster. Your 40s. You're entering middle age, still in your prime earning years, but now you've got bigger savings goals. Sending kids to university, paying off the mortgage. Depending on your retirement plans, you might want to add more portfolio stability by shifting equities into bonds. Here's the key. The sooner you want to retire, the sooner you should think about shifting your asset allocation. If you're planning to retire at 55, your 40s are when you start getting conservative. If you're working until 67, you can still afford a moderate or even risky approach. Allocations. Risky, 85% stocks, 15% bonds. You're still heavily in equities, but you're acknowledging that retirement is getting closer. Moderate, 75% stocks, 25% bonds. Balanced. This is where most people land in their 40s. Conservative, 60% stocks, 40% bonds. This follows the rule of 100. If you're 45, you subtract 45 from 100 and you get 55% stocks. 60% is close enough. If you still have 20 plus years until retirement, you could still afford the moderate or risky approach. The stock market over 20-year periods tends to be positive. You've got time. But if you're planning early retirement or you've got major expenses coming up like university tuition, adding more bonds makes sense. And by the way, university costs in Europe are generally lower than in the US or other regions, but they're still significant. Plan accordingly. Your 50s. Retirement is coming in the next 10 to 15 years depending on your country's retirement age. The most aggressive you should probably be is 80% stocks, 20% bonds, and honestly, that seems a little risky. Here are the allocations. Risky, 80% stocks, 20% bonds. You're still growth focused, but you're acknowledging the clock is ticking. Moderate, 70% stocks, 30% bonds. This is the sweet spot for most people in their 50s. You're balancing growth with capital preservation. Conservative, 50% stocks, 50% bonds. This is for someone who's very risk averse and wants maximum stability. Here's some context. Average pension savings in Europe in your 50s varies wildly, anywhere from 50,000 euros to over 200,000 euros depending on your country and your national pension system. You should be aiming for the upper range. Ideally, you're contributing 15 to 20% of your salary into savings and retirement. You're trying to capture the upside while reducing risk. Capital preservation becomes more of a priority in your 50s and 60s. You can't afford a major market crash wiping out half your portfolio when you're 5 years from retirement. With 15 years left until retirement, there are still plenty of 15-year stretches in stock market history where you could lose money. Global stock annualized real returns over 15-year rolling periods show some negative data points. It's rare, but it happens. And here's the other thing. The distribution of stock market returns over 146 years of data shows the chance of seeing negative returns in any given year is about 31%. 1 out of every 3 years could be a losing year. So your 50s are not the worst time to be invested in stocks, but they're also not the safest. That said, over any 10-year rolling period, you usually see positive gains. Typical returns are around 6 to 7% annually accounting for inflation. So if you're 55 with 10 years until retirement, history suggests you'll probably be fine. Probably. But probably isn't guaranteed, and that's why you add bonds. Your 60s. This is the decade where retirement age strikes across Europe. 62 in France, 65 in the Netherlands, 66 to 67 in Germany, Ireland, the UK. Your asset allocation is likely shifting way more toward bonds and less into equities. You might even add more cash in euros for liquidity. If you haven't retired yet, you can still make contributions to occupational pension schemes and maximize employer contributions where available. Buff up that pension pot before you stop working. Allocations. Risky, 75% stocks, 25% bonds. First question, why are you still risky in your 60s? Maybe you need to catch up. Maybe you don't need the pension funds to have a good retirement because you're already financially independent. But for most people, this is too aggressive. Moderate, 60% stocks, 40% bonds. This is where most European retirees land. You're relying on a combination of state pension and private pension for retirement income. Conservative, 40% stocks, 60% bonds. This is the conventional approach. Heavy on bonds for stability, and as you age past 70 or 80, you'll see that stock allocation drop even further. 20%, 15%, even 10%. Bonds go up to 80 or 90%. Why? Because you're drawing down your portfolio, you're using it for income. And you can't afford big swings, you need stability. Most European retirees use a safe withdrawal rate of 3 to 4% per year. Actually, European retirees often use a slightly lower rate than 4% because life expectancies in Europe are longer than in other regions. You need your money to last longer. Your pension pot and your investments should hopefully cover that withdrawal rate and more. If your investments can't cover the safe withdrawal rate at retirement age, you've got a problem. You might have to work a few more years, or you go riskier, which is dangerous when you're already retired. Here's the European context that matters. Many countries have generous state pension systems. Netherlands, Denmark, Germany. These pensions supplement your private savings significantly. Other countries like the UK or Poland require more private pension reliance. That affects your appropriate allocation strategy. If you're getting 1,500 euros a month from the state pension in the Netherlands, you can afford a slightly riskier private portfolio allocation because your base expenses are covered. If you're getting 500 euros a month, you need a much more conservative private portfolio because you're relying on it heavily. Now let's talk performance. There's a global investment study covering 1926 through 2022, nearly 100 years of data. It includes the 1929 stock market crash, the Great Depression, everything. The study tracked different asset allocations and their average annual returns and worst possible returns. And the findings are fascinating. The worst 12-month return was approximately negative 61%. The best 12-month return was around 136%. Huge swings over 12 months. But here's what's interesting. Over longer time horizons like 5, 10, or 15 years, returns converge more toward the mean. The volatility smooths out. And in all approaches, the worst 20-year return annualized was still positive. That's a really great sign for long-term European investors. Time is your ally. But time only helps if you're actually invested. If you're sitting in cash earning 0.5% interest while inflation runs at 3%, you're losing purchasing power every year. You have to be in the market. Stocks, bonds, a mix. But you have to be in. Now let's address the European-specific considerations, because this is where European investors face unique challenges that American investors don't. First, currency risk. When you invest in global stocks, you're exposed to US dollars, British pounds, Swiss francs, and other currencies. If the euro strengthens against those currencies, your returns in euro terms get diluted. If the euro weakens, your returns get boosted. You can use currency-hedged ETFs. EUR-hedged versions exist, but they have additional costs. And for long-term investing, most experts say currency risk balances out over decades. Don't overthink it. Second, UCITS regulations. European investors can only buy UCITS-compliant ETFs. You cannot buy US-domiciled ETFs like American investors can. But here's the thing, that's actually an advantage. UCITS regulations ensure investor protections and transparency. These funds are regulated, they're safe, you're not missing out, you're protected. Third, withholding taxes. Dividend withholding taxes vary by ETF domicile. Ireland domiciled ETFs typically have 15% withholding tax. Luxembourg varies. Choosing the right domicile can save you significant taxes over decades. This is worth researching based on your specific country. Fourth, accumulating versus distributing ETFs. This is a major advantage for Europeans that Americans don't have. Accumulating ETFs defer taxation until you sell. In most European countries, that means you're compounding tax-free for decades. Always check if an accumulating version is available. Prioritize those for taxable accounts. The exceptions are Austria, Switzerland, and the UK, where distributing shares might be equivalent. But for most of Europe, accumulating is king. Fifth, multiple tax systems. There are over 30 different tax systems across Europe. The optimal strategy in Germany is different from Spain or Poland. You need to research local tax-advantaged accounts, ISAs in the UK, PEA in France. Country-specific pension schemes. Capital gains tax treatment varies. Dividend tax treatment varies. Do your homework. This isn't one size fits all. And sixth, state pension integration. Your allocation strategy should account for expected state pension income. Countries with generous state pensions like the Netherlands averaging 1,500 euros a month or Germany averaging 1,200 euros a month mean you can afford slightly riskier private portfolio allocations. Countries with minimal state pensions require more conservative private savings because you're relying on your portfolio more heavily. Asset allocation is a highly personal decision, but this video provides a general guideline for European investors. Your goals might change throughout your life. Your asset allocation and risk tolerance might change as well. Reference this video as your situations evolve. But remember, European investors have additional considerations beyond age and risk tolerance. Country-specific retirement ages, tax systems, pension structures, UCITS regulations. You need to adapt this general framework to your local circumstances while maintaining the core principles. Diversification, age-appropriate risk management, and consistent contributions over decades. Your future wealthy self is looking back at this moment right now. The version of you at 65 with a pension pot that actually works. That version exists because of the decisions you make today. In your 20s, your 30s, your 40s, Every decade you had a choice: stay aggressive and capture growth, or shift conservative and preserve capital. Both are right at different times. The only wrong move is doing nothing. What financial topic is keeping you up at night? Taxes, real estate, the euro? Tell me in the comments. That's what this channel is for. Breaking down the money topics that affect your life in Europe that nobody else is explaining properly. You're not just building a portfolio. You're building the life that portfolio makes possible. And that life starts with getting your allocation right. Today,